Picture this. The stock market is crashing. The news headlines are screaming in red, and fear is dominating the global markets. Most investors are panicking, selling their hard-earned shares at a loss. But you are not panicking. In fact, you are calmly watching your favorite stocks become cheaper. Why? Because you don't see a tragedy. You see a once-in-a-decade sale. Today, we are going to talk about how to survive market crashes, master dollar cost averaging, and understand how stock splits actually accelerate your path to wealth. Welcome back to Steady Cash Flow. If you've been following our journey, you know we aren't here to speculate or chase overnight riches. We are building a financial fortress, and every fortress must be tested by storms. In the world of investing, those storms are market crashes and recessions. The average person views a market drop as a threat to their wealth, but a strategic dividend investor views a crash as an injection of raw fuel into their compounding machine. This brings us to our primary weapon during a downturn, dollar cost averaging, or DCA. When you commit to investing a fixed amount of capital regularly, month after month, market volatility becomes your ally. When prices are high, your fixed capital buys fewer shares. But when the market crashes and prices plummet, that exact same amount of money suddenly buys significantly more shares. You are automatically buying the dips without having to guess or time the market. Over time, this systematically lowers your average cost per share, positioning your portfolio for massive gains when the market inevitably recovers. But crashes aren't the only event that can change your portfolio's landscape. Let's talk about stock splits specifically, bonus share issuances, or what we call bonus splits. Imagine you own a single share of a company worth $100. If the company decides on a 100% bonus split, you suddenly own two shares, each worth $50. Your total portfolio value remains exactly the same on day one. So why does this matter? Because of the psychological impact and liquidity. Lower share prices attract more retail investors, often driving the price back up. More importantly, it dramatically increases your overall share count. Think of how this connects to your dividend snowball. If you previously held 100 shares paying a specific dividend, and a bonus split increases your holding to 200 shares, your foundation has just doubled. When the company continues to grow and increases its dividend payout per share in the following years, your yield on cost skyrockets. You are now receiving dividends on double the amount of shares. This is how a quiet, long-term portfolio suddenly turns into an unstoppable, high-yield passive income stream. The secret to surviving and thriving in global markets is simple: discipline over emotion. When others panic, you execute your plan. You DCA. You accumulate shares, and you let corporate actions like stock splits multiply your asset base. If you are ready to stop reacting to the market and start exploiting it, make sure to subscribe to Steady Cash Flow. Leave a comment below with your strategy for the next market downturn. Until next time, keep building your fortress.